Welcome to today's video, where we uncover a powerful, time-sensitive move that many couples overlook: maximizing Roth IRA contributions before the tax deadline. As we move through this guide, you'll learn how married couples, including those with non-citizen or recent immigrant spouses, can legally and efficiently capture tax-free growth for decades. Furthermore, we'll address eligibility rules, a smart funding hack, and the urgency behind the annual deadline so you do not permanently lose this year's contribution window. Let's begin. Here is the roadmap for today's session. First, we will explain why missing a Roth IRA contribution deadline can permanently reduce your lifetime tax-free growth. Next, we will review eligibility rules for spouses, including resident non-citizens, and clarify how residency tests may apply. Then, we will walk through the wealth hack that allows one spouse to fund the other spouse's Roth, even when cash feels tight. After that, we will outline exact deadlines, limits, and a step-by-step action plan. We will also highlight common pitfalls to avoid. Finally, we will include quick quizzes to make sure the key points stick. Before we dive deeper, please remember this content is for educational purposes only and is not legal, tax, or investment advice. Your personal circumstances may vary, especially around residency status, filing status, and state community property rules. Therefore, consult a qualified tax professional or financial advisor to confirm how these concepts apply to your specific situation. Let's set the stakes. A Roth IRA offers tax-free growth and tax-free withdrawals in retirement when rules are followed. However, the annual contribution window closes with the tax filing deadline. If you miss it, you cannot go back and fund that year later. Consequently, the opportunity cost is not just the dollars you could have contributed, it is the compounded, tax-free growth those dollars could have generated over decades. In other words, delaying a contribution can be permanent financial self-sabotage. Now, let's clarify eligibility. First, for a spouse who is a non-citizen, they can still be eligible if they meet IRS residency tests, such as the green card test or the substantial presence test, and they have the required identification like an SSN or ITIN. Second, IRA contributions require taxable compensation. When you are married filing jointly, the couple's combined taxable compensation can cover both spouses' IRA contributions, even if one spouse has little or no earned income. Third, Roth IRAs are subject to modified adjusted gross income limits that phase out contributions at higher incomes, so you should verify the current IRS thresholds for your filing status. Fourth, each spouse must open a Roth IRA in their own name. There are no joint Roth IRAs. Fifth, you can contribute for the prior tax year until the standard tax filing deadline, usually in mid-April, and filing an extension generally does not extend the IRA contribution deadline. Finally, when you contribute at the start of a new year for the prior year, make sure you designate the correct tax year with your brokerage so the contribution is recorded properly. Let's correct common misconceptions. First, citizenship is not the sole determinant. If a person is a resident for tax purposes under IRS rules, they may be eligible to contribute to a Roth IRA. Second, while contributions require sufficient taxable compensation, the actual dollars used for funding do not have to be the earned income dollars themselves. Any cash source can be used to make the contribution. Third, Roth IRAs are individual accounts. You cannot open a joint Roth IRA. Fourth, filing a tax extension does not typically extend the IRA contribution deadline. Understanding these distinctions will help you act with confidence. Here is the core wealth hack. Even if the higher-earning spouse feels cash-constrained today, the other spouse can fund their own Roth IRA using personal savings or non-earned dollars such as a gift or inheritance, provided the couple has enough taxable compensation to support the contributions. In many states, assets earned during marriage are treated as shared, which can make this transfer straightforward. However, each Roth IRA must be opened in the owner's name. You can link a spouse's bank account to facilitate the funding. The key is to contribute now and invest, because waiting can permanently eliminate that year's tax-free growth potential. Additionally, consider automating contributions for the new year. If your income exceeds the Roth MAGI limits, discuss backdoor Roth strategies with a qualified professional before proceeding. This decision flow begins with the question of whether you qualify as a resident for tax purposes. If not, you must consider non-resident rules. If yes, the next step is confirming your filing status. Married filing jointly allows the couple's combined compensation to support both contributions. From there, verify that your combined taxable compensation is at least as large as your planned total IRA contributions. Next, evaluate your modified adjusted gross income to ensure you are within the Roth contribution thresholds. If you are above the limits, the flow directs you to consider a backdoor Roth strategy with professional guidance. The diagram also reminds you that ownership is individual, and the deadline is the standard tax filing deadline, generally mid-April, which is not typically extended by filing an extension. The flow concludes with two outcomes: contribute now and invest, or resolve any issues and then fund promptly. Here are recent contribution limits and typical deadlines. For 2024, the Roth IRA limit is $7,000, with an additional $1,000 catch-up for those age 50 or older. For 2025, the limit increases to $7,500 with the same catch-up amount. The prior year funding deadline is generally the standard tax filing deadline in mid-April of the following year. These dates may shift slightly due to weekends or holidays, and special disaster relief can alter deadlines. Always confirm the current IRS figures and your custodian's processing cutoffs. Here is your concrete checklist. First, verify residency status and ensure you have an SSN or ITIN. Second, confirm your filing status and that your combined taxable compensation is sufficient to support both spouses' IRA contributions. Third, check your Roth income limits for the relevant tax year. Fourth, open a Roth IRA for each spouse to maintain proper ownership. Fifth, connect your funding source and make sure to designate the contribution for the correct year, especially when contributing in the new year for the prior year. Sixth, invest the contributions according to your long-term plan, such as using low-cost, diversified index funds. Seventh, set up automatic contributions for the new year so you do not scramble next April. Eighth, save all confirmations and statements for your records. Finally, if your income exceeds Roth limits, pause and discuss a backdoor Roth strategy with a professional before proceeding. Quiz time. The question is, true or false, you must use earned income dollars themselves to fund a Roth IRA contribution. The options are A, true, and B, false. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, false. While you must have sufficient taxable compensation to qualify for a Roth IRA contribution, the actual money you contribute can come from savings, gifts, or other non-earned sources. Second quiz question. When is the typical deadline to make a prior year Roth IRA contribution? Your options are A, the standard tax filing deadline, usually mid-April, without relying on extensions. B, October 15th if you file an extension. C, December 31st of the tax year. Or D, April 1st of the following year. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. The typical deadline to make a prior year Roth IRA contribution is the standard tax filing deadline, generally in mid-April. Filing a return extension generally does not extend the IRA contribution deadline. Here are the common mistakes to steer clear of. First, postponing until you feel more prepared can cause you to lose the year's Roth space permanently. Second, when funding in the new year, many people forget to designate the prior tax year and end up misallocating their contribution. Third, do not attempt to open a joint Roth IRA. These accounts must be individual. Fourth, do not ignore the Roth MAGI phase-out ranges, as making an ineligible contribution can create corrective headaches. Fifth, near the deadline, brokerage processing cutoffs and settlement times can cause delays, so plan ahead. Sixth, remember that filing extensions generally do not extend the IRA contribution deadline. Finally, consider how your state's marital property rules apply, and seek professional guidance if uncertain. This timeline lays out a simple annual rhythm. From January through December, you are in the tax year for which contributions apply. From January through mid-April of the following year, you have a window to fund the prior year's Roth IRA contribution. The standard tax filing deadline, typically in mid-April, is the hard stop for prior year contributions. From May through December, you continue funding the current year, ideally on an automated, monthly basis. At year's end, review your income relative to the Roth MAGI limits and reconcile your contribution totals. This pie chart is a visual metaphor. One slice represents the tax-free growth you capture by contributing this year, while the other slice represents the tax-free growth you forfeit permanently if you skip. The point is not the exact ratio. The point is the binary nature of the deadline. You either lock in this year's Roth space, or you lose it forever. Let's crystallize the main points. First, missing the contribution deadline permanently erases that year's Roth space. Second, if you are a resident taxpayer, you may be eligible to contribute, even as a non-citizen. Third, each spouse must have their own Roth IRA, and while contributions require sufficient taxable compensation, the funding dollars can come from savings or other non-earned sources. Fourth, confirm your income against Roth MAGI thresholds and label contributions for the correct tax year. Finally, act early and automate to reduce stress and prevent errors. To wrap up, take action now. Open or verify each spouse's Roth IRA today. Designate and fund any remaining prior year contributions before the deadline. Set up automatic contributions for the current year so you stay on track. If your income is too high for a direct Roth contribution, consult a professional about backdoor Roth options. By acting promptly, you secure a lifetime of tax-free growth that cannot be reclaimed later. Thanks for watching. If this helped you, please like the video, share it with someone who needs a deadline nudge, and subscribe for more practical wealth strategies. In the comments, tell us your plan for locking in this year's Roth contribution and what questions you want answered next.